Let me switch focus though. Vikram Sahu, who's the India CEO at Bank of America, joining at BofA Securities, joining us. He's live in conversation with Sajid Mangat. Let me toss it there.
Hello and welcome to ET. Now we are at the Bank of America's 2026 India Conference, and with me is Vikram Sahu, who is the India CEO and Country Executive for Bank of America. Vikram, thank you for joining us on ET. Now, to begin with, it's a conference where we have more than 400 foreign investors in India. What are they telling you about India?
So, good morning, Sajid. Thank you for having me on the program. So it's an interesting question. And if you think of what the actions of FIIs have been over the last year, as giving you one message, where we've seen FIIs sell down India and exit from India. And so when you look at FII ownership in India right now, we're at about a 14-year low. So coming into this period and planning for the conference, I wasn't sure in my mind about what the turnout was going to be. And what we found instead is that there's been a 30% increase in FII participation in the conference this year relative to last year. So maybe that's telling us that what FIIs are doing is to say that they voted with their feet over the last many months because valuations were stretched, because they had concerns in their mind about factors like AI and what would mean for India. But they're still prepared to roll up their sleeves, sharpen their pencils, talk to companies, talk to policymakers, and try to establish whether this is a point in time at which they should take another look at India and look at Indian companies. Because as always, there's a right price for everything.
Interesting, because if you look at some of the numbers which you spoke about as well, this year alone, we have FIIs have sold nearly 2.25 lakh crores. Over the last 17 months, around 3.5 lakh crores, which have gone out of the country. And still, we are at the same kind of valuation despite that, because we have been supported by a good DI flows, which is supporting the market. In the absence of a sizable correction or value correction which is coming in, do you think that FIIs are now waiting for a time correction before they come in?
That's partly it. By the way, before we go there, what I do want to say is thank goodness for domestic inflows. And that's an entirely healthy thing when it comes to Indian capital markets, because you're not as dependent on foreign investments in India as you were perhaps in the past, at least for equity markets. Now, coming to a question about what are people waiting for. In part, there has been a value correction over the last year. And when you look at it in rupee terms, then certainly there has been a more pronounced correction than just the indices would suggest. In part, it's a time correction, because one of the other issues that investors were concerned about was earnings downgrades for India over the last year. And our best sense is that while we may not be quite at the end of that entire cycle of downgrades, we're getting pretty close to it. And so intrinsically, that would make this, at this entry point and at this point in terms of what earnings expectations are, a little bit better than it would have been 12 or 18 months ago. But I don't think we're out of the woods yet, because all of the issues that are on investors' minds have not been resolved. And I'll just cite two of them. The first one is the turmoil in West Asia. That was nothing to do, it was not of India's making.
Yes.
But because of our dependence on energy imports, we find ourselves caught up in it. And the big unknown is what is the duration of this turmoil going to be? If it is something that is quickly resolved, then that's another sort of overhang on India that investors are going to be able to get past. But if, on the other hand, if this extends for a prolonged period in time, then we may not be at the bottom yet, because there will be consequences for Indian earnings, for the Indian economy, and so on and so forth, which has an implication for financial markets. So that's one big variable. The other variable, of course, is AI and what that means for India, particularly given just how India's benefited from IT services over the last quarter of a century. And then the question mark is, well, what does this mean for India going forward?
Interesting. You spoke about earnings. Last 2 years, we've been sub 10% in growth, earnings growth. The Q4 numbers were very good. We had more than 10% of growth coming in. But then you have this West Asia crisis, which is coming in, which is again putting some downgrades on the earnings there. Do you think the foreign investors are now going to not just look at the index, but also the value play here, the growth stories which are there? Nearly 400 of foreign investors are here in your conference. Are they looking for ideas? Are they looking for what's the next value play which is available, not just from a country valuation, but from growth, individual bottoms-up approach?
So, I think that's always been the case, because the institutional investors that tend to attend our conferences, both domestic as well as foreign, are very fundamentally oriented. Yes, macro is important, and they do think about whether macro provides a headwind or a tailwind, but they have always been people who are prepared to actually sit down and really drill down into individual companies, look at the bottom-up fundamentals, and try to decide whether the bottom-up fundamentals justify investment. So that, I don't think, is actually changing with the cohort that is here at this conference.
You spoke about the fact that two factors are there, geopolitical and AI, which is now determining how FIs are going to play. What about the macro factors? Do you think they have a comfort level when it comes to macro stability, growth? We have a current account deficit, which is there, which is again putting pressure on the rupee as well. Is that a concern at all?
Yeah. So the rupee has been something that comes up in lots of conversations. And by the way, not just conversations with institutional investors, but with corporates as well. Because the depreciation of the rupee in the last year has been more pronounced than you have had in prior years. So it's certainly clearly something that's on investors' minds. Having said that, I think the Indian government has a lot of credibility with observers of India. And the reason for that is twofold. One is because the consistency of investments that the Indian government has made in the decade prior to this. And second is the responsiveness and the speed with which the administration has reacted to some of the challenges that India has faced over the last year, whether it was the lack of a trade deal with the US, or whether it was West Asia, or whether this overhang of AI. And what we've seen in the last 6 or 8 months is a slew of trade deals, more trade deals announced than in the prior many years before that, including, by the way, a framework deal with the US, which was announced in February. And then in addition to that, a whole slew of reforms that have also been pushed through. So I think the Indian government's posture has been, yes, this is a turbulent time, but you don't let those turbulent times go to waste. And what you try to do is you try to respond to them and react to them. And so for that reason, while there may be some consternation about the depreciation of the rupee, I still think that the credibility of policymakers in India is quite high with the investors that we're talking to and with the corporates that we're talking to.
Now, you just completed 1 year in POFA India. And you've seen two major events happening, which one is your trade and the other one is West Asia. From a policies point of view, how do you think India has managed both of them?
Yeah. So actually, let me just say one thing. So I've completed my first year at Bank of America in India, but the bank itself has been over here for more than 60 years and has got very, very deep roots within this market. So this is not a market that is not familiar to the bank, or which the bank does not have, high conviction in. So if your question was to say, what does the turbulence of the last year mean for the firm's commitment to India and its plans and its aspirations for India, it hasn't changed at all. We like India because of the size and scale of the economy, because of the velocity of growth, and also because of the governance and the regulatory frameworks that we operate in within India. So we're very, very committed to the country for that reason, and we have strong aspirations for our presence here in India. When it comes to institutional investors and corporates, I would actually say that when you look at the responses from other governments around the world, I actually think that the Indian government is acquitting itself extremely well with the speed and the proactiveness with which it's trying to address the situation that it finds itself in.
And because you manage multiple businesses in India, not just securities, but also corporate banking and M&A financing, others, which is a big business for you. How do you think Indian corporates are looking at this opportunity, these challenges? Are they leveraging this for their advantage to go global in that sense?
So there's two sides of the coin. I'll talk about Indian corporates and I'll talk about foreign corporates and how they look at India. With Indian corporates, these are real companies with real costs of capital, professional managers that are determined to deliver for their shareholders and maximize their returns. And I think that Indian corporates are actually, again, very adept at responding to the circumstances that they find themselves in, and extremely professionally managed. So I have no concerns on that front in terms of the activity levels that we're seeing with the corporates that we're engaging with on our corporate banking businesses. When it comes to foreign corporates, I guess the subtext of the question is to say, will foreign corporates change the way they think about India because of this turbulence? And the answer is no, absolutely not. We see undiminished interest in India. And that's because if you look at the intrinsic reasons that they're focused on India, that has not changed. And again, it comes back to the points I was making earlier, which is size and scale of the Indian market. So even in these difficult times, you're going to have GDP growth of about 6.5% this year. Contextualize that against global GDP growth of 3%, we're growing at more than twice that rate. And that's not shabby for an economy that's in the fifth largest economy in the world. The second is so size and scale, velocity of growth, and like I said, regulatory and governance frameworks that are very robust over here in India. So no diminution of interest over there.
My final question to you is on the AI part of it. You said that's one of the challenges that India is facing. How do you think Indian companies are managing that challenge? And from a securities point of view or the markets point of view, how do you think is the sell-off overdone for India as an anti-AI trade?
Okay, so I don't think that the market is being irrational in trying to think about what AI means for economies in general, and then for India in particular, given that we're sitting and talking about India. In India, it's a particularly pronounced question because if you look at IT services, it's been an engine of growth over the last quarter of a century. Per capita income in India is roughly about $3,000, but it would be half that if you took out IT services. So it really is a big question mark. Now, coming to your question about how corporates are responding to it, and I think it's being done in a measured way. I think we're at the very early innings of enterprises understanding how to deploy AI, deploy it at scale, and in the first instance, deploy it for productivity gains. I think that's the first innings of what we'll see. The second innings is to say, well, okay, how can we also use it to maximize revenues? Because when you get those two together, that's when AI delivers on its full potential. And I think that is, again, something that we have to yet see play out. But it's an entirely natural process of discovery because, like I said, we're in the very, very early innings of AI. Just remember, ChatGPT burst onto popular consciousness about 2 years ago.
True.
So it's early days yet.
Vikram, it was a pleasure talking to you today. Thank you very much for joining us on ET Now.
Thank you for your time.
Thank you.
Hello and welcome. It's a tough market this morning, but we've recovered from the lows. Actually, we continue to be around 0.5% thereabouts lower, 100 points odd down. The indicative open, of course, was 200 points lower for the gift nifty at the start of the day. So we're doing relatively okay. In terms of sectors, IT continues to rule the roost, doing fairly well for itself this morning. 3.5% high on the Nifty IT index now. So some real positive traction seen there. Metals holding up fine. Pharma, finance, bank, auto are some of the drags. That's really the tilt of the trade. In terms of the Nifty index itself, I did mention that's down around 0.5% thereabouts, but the Nifty mid-cap and small-cap indices have recovered decently well from the day's lows. So you're seeing some decent traction there. The Nifty Bank continues to be lower, 0.8% lower. In terms of contributors as well, it's the IT stocks which are really contributing to the Nifty as well in trade today. Seeing some very decent gains. Infi, TCS, HCL, Tech combined contributing roughly 80 odd positive points to the Nifty 50 index, even though the Nifty is down around 0.5% thereabouts. So you're still seeing some decent gains being clocked within that IT pack and contributing to the index. We're still trending lower though, and that's one of the concerns. But shifting focus, we have Malana Sasalu, who's the CEO, South Purvankara, joining us on the back of a new launch, 1,100 crore in terms of GDV. Mr. Salu, give us a perspective. This takes your total GDV, I believe, currently to approximately 18,000 crore. Correct me if I'm wrong.
Yeah, thank you very much, Harsh, and thanks for having me here.
Very good having you here.
So we closed the deal. That's 1,100 crore rupees. That's the total GDV, as you said, and it's in Dodagubi, Bangalore, north of Hennur Road. It's a great location. We're very happy about it. And also recently, the last week, we closed another deal in Mundur, that is in Bangalore, northeast, closer to the Old Madras Road. That's another 2,300 crores. So we've started off the year very well, replenishing whatever we have sold, and so that we have steady supply to the market. As I said, that in the last year that we did around 18,000 crore rupees of total deal closures, and previous to that we had done around 15,000 crore rupees of deal closure. So all of that put together at 28,000 crore rupees in the last 3 years is what we have added. And this year we're bringing around 24,000 crore rupees of total asset to the market, total GDV value units to the market. So roughly around 8,000 to 9,000 crore rupees in Mumbai, and rest coming from the south. So yeah, we're very happy to be where we are today. So just looking for the future, hopefully that it holds good, and we should be okay.
What's your total GDV currently, Mr. Sasalu? If you can give us a perspective on that.
The total GDV goes in 3 buckets. One is projects which have been acquired and which have been approved and which are in the market and selling. And the other part is that the one which is under acquisition. The other one is what is acquired and yet to be launched. So in total, I think we have 55,000 crore rupees of total GDV we have at this point of time as a group.
You intend to add maybe another approximately 20,000 crore for the year?
We are aiming for such a number, but we don't know the number of assets, and the quality of assets that will be available in the market is always a challenge. Whereas that on the other side, on the funding side, we are fully equipped to do such kind of an acquisition. And also that we want to be really balanced about what this acquisition means. Then it has to be a little bit of that joint development agreements, and also capital deployment, where we see that there are higher margins. Then we are looking at capital deployment, and where we think that it's better to go with the landlord to have that kind of measured risk. So I think we should be somewhere between 15 and 20,000 crores, I think.
Okay. That makes sense. And that should take your GDV to 70,000 crore, right? Is that the right trajectory that I'm taking?
Yeah, there's and whatever we sell in this year, and we've already given a guidance that we want to sell around 11,000 crore rupees this year, which means that minus that, so that would be the GDV that will be there. So the continuous replenishment of quality assets is the way to go along, combined with good sales numbers. That's the idea.
How is execution likely to play out in the current year? Give us a sense of that, because that's where maybe the numbers aren't stacking up for you. Is FY27 going to be that year?
No, yeah, our execution is quite strong. If you really look at it last year, and we have 4,000 crore rupees plus, that was our revenue recognition. The collection was for 4,260 crores. And in fact, we have really very well streamlined. And if you have done anything that's great in the last 1 or 2 years, that has been our execution capability has really improved quite a bit. Of course, the challenges that are going to be outside the organization would be the labor and the costs and other things, with whatever the West Asian conflict, and also with regards to what are the crude oil prices, so on and so forth in the larger economy around the world. While India is doing fantastic, but around the world there is disturbance, and so those things may have a little bit of effect, but that's not in our control. But whatever is in our control, I think we've got a really good execution capability at this point of time.
Okay, point taken. So what's the execution looking like for FY27? What's that number?
I couldn't put a finger on a number and say, but we should be able to do better than what we did last year. So that's around 4,000 crore rupees is what we recognize. That is, execution means handing over. That means procuring the OC and handing it over, and we should be able to do better than that. And so I think at least add another 25% to what the last year number was.
Excellent. And with regard to your well spread, at least, so while you're concentrated in the south, but you're well spread otherwise, you've got a good presence across west, as well as Mumbai, Pune markets as well. You have a decent presence. How's pricing holding up? It's obviously a tumultuous time in terms of everything that's happening. But how is pricing at this point holding up? How is demand holding up?
So far, we have not seen any kind of slowdown. And let me, 60% of our portfolio is in the range, because we are a full stack developer. We started around 65-70 lakhs rupees, all the way going up to 15 crore rupees. So in that whole spectrum of the goods that we have in the market, we've not seen the 1 crore rupee to 2.20 crores. We don't see any kind of slowing down, and in fact, we have really improved our sales in all our sustenance projects. Whereas anything when it goes beyond 3 crore rupees, yes, there is a little bit of wait and watch kind of a thing. People walk in and they weigh in, and that part of the thing is there at this point of time. What I call the frenzy in the 2022 to 2025 may not be there, but it's a steady market, and we all believe in the great India growth story that we've all believed in. And I'm pretty sure that, yes, the blips in the market are all temporary, and we will do well.
In terms of sales and collections, you've substantially upped the guidance for FY27 versus FY26. That 11,000 crore number is extremely strong. Do you believe that despite all of the headwinds that are playing out, especially on the supply side, I'll speak about, or rather the demand side, I'll speak a little bit about the supply side constraints with regard, you spoke about labor and the like, I'll speak about that in just a minute. But with regard to a possible demand headwind coming your way, is that at all a concern, or you'll continue to lock that 11,000 kind of number?
The concerns will always continue, as I said, that what is not in our control. Our assumption is that whatever may be the situation, India will hold good, and that's the assumption. And I think not just us, that I think the entire our industry and the entire the whole gamut of the business that is there in the country, that we all hope that will continue. At 6.5% growing in India is still a large growth when I say that. And also, on coming to the exact, the residential offtake in India, it's all basically based on the job generation. And job generation in India is still strong. And if you look at office offtake that has happened in the last 1 year, 1.5 years, and even in this quarter, it's pretty strong, which means that there is, apart from, whether it is AI, whether it is IT, whether it is GCC, and it seems like everything is, firing on all cylinders. So which will translate to the residential sales. So I'm not too worried about that part. Yes, something that happens around the world, which will have an impact on us, that I couldn't say much about that part. So we expect the demand to continue.
With regard to the new levers for growth, data center, warehousing, also, you're getting into in a bigger way by building the 3,000 square feet of lease space in Thane. How much of that contributes to top line, say, a couple of years or 3 years from now? Could you quantify that for us?
To be realistic, that we are not in data center, or we are not in logistics business, and we are in office and residential predominantly, and we are in retail business in terms of where we build large townships, where we have the retail that is built along with the township is what is the retail portfolio that what we have. At this point of time, we have a portfolio of around 4 million square feet of office space, and we have built around 1.2 million square feet in Bangalore and Purva Aero City, which is up for leasing, and we have finished around 800,000 square feet in Kanakpura Road in Bangalore. That is, again, we are now looking at leasing, and the leasing is quite strong, and we've already done around 45 to 50% leasing on that asset. So that is around 15 to 20%. It contributes to our total listing. Otherwise, we are predominantly today a residential developer.
Okay. Lastly, trying to get a sense, you spoke about the headwinds with regard to costs. Of course, understandable. You've got metal prices which are elevated. You've got cement pricing, which, at least in the system, there is an attempt to increase pricing there. I'm not sure how much of that is fully translating. And you've got the headwinds with regard to labor. Is timing or execution proving to be a challenge because of this? And what's the impact like on margins?
Execution is not a challenge. Yes, when the labor, particularly that, it just coincided with Bengal election and the festivals, all of them came together. And we are already seeing the labor coming back to work. And of course, still around 20% or so less than what is our anticipation or what is our expectation for the people to be on site. And it's a concern, right? It's a concern. And, the mechanization has happened, and we were not doing most of the things what we used to do 5-8 years back. And so now a little bit more mechanization has happened. Apart from that, on the cost side, yes, it is a concern. With the crude oil, hovering around $100, and also the currency value going down, so which has resulted in the prices of petrol and diesel and all the petroleum products going up, which has resulted in metals like copper, aluminum. Those things are going up. So it's a cause of concern. But nevertheless, there are contingencies. Yes, will there be a little bit of compression in our margins? And I think it has somewhere it has to balance out. And I think that's where it balances out, I guess. So something that, as I said, that, yeah, the prices are a concern.
Mr. Sahu, great having you here. Good getting this perspective out of the way. Thank you so much for coming in and speaking to us.
Thanks, Harsh. Thanks for having me.
All right, viewers, what we'll do is close the show. First Trades on the back of that. Completely timed out on this edition of First Trades. Thanks so much for joining us. And more action on the other side. You want to stay tuned here on ET Now. To mid-cap masala here on ET Now. Quickly on to the headlines. Let's quickly have a look at the day's top stories. NHPC is a stock which is under pressure in trade as the government of India announced an offer for sale to divest 3% stake in the company with an option to sell an additional 3% through the green shoe mechanism. The OFS floor price has been set at 71 rupees a piece, which is a rough 5% discount to the current market price. If the entire issue is subscribed, the government stake in NHPC will reduce from 67.4% to 61.4%. Force Motors too is taking it on the chin in trade today after reporting a weak set of May auto sales numbers. Total sales declined 15.5% to 2,614 units. Domestic sales fell 15% YOY. Exports saw a sharper decline of 37% YOY, reflecting weakness across both domestic as well as overseas markets. And Anant Raj is doing well today after announcing plans to invest 25,000 crore in developing data centers and cloud services infrastructure in Haryana, marking one of the company's largest digital infrastructure commitments to date. The company has signed an MOU with the Haryana Enterprises Promotion Center to support development of data centers and cloud services capacity in the state. And Transrail Lighting has secured new orders worth 575 crore across T&D, civil and pole segment. The company additionally holds an L1 position of approximately 400 crore and maintains robust bidding pipeline, reinforcing its long-term growth and execution outlook. Last off, PNC Infra has received a letter of acceptance worth 194 crore from the Lucknow Development Authority, Uttar Pradesh, for construction of a 4-lane flyover in Lucknow on an EPC basis. There's also the development engineers. They've secured a 207 crore order from an undisclosed Maharatna PSU. As per the contract, the company will provide manufacturing supply of critical piping assembly to power sector PSU EPC conglomerate. All right, Snehi also joining me on the show. Snehi, how are markets doing?
Markets are looking better than where we had started, at least. We've seen some recovery from the day's low. So looking good for the Nifty compared to where we had started. So you still have a cut of about 0.2% on the Nifty, but at least we're now above that 23,300 mark. And the broad end of the market is in tandem with the benchmarks. You've got cuts of about 0.2% on the Nifty small cap index. Nifty mid cap is lower by about 0.4%. So that's the kind of move that we're seeing in the market right now. A bunch of buzzers, of course, on the back of news flows. You've got some brokerage reactions coming in. A bunch of stocks buzzing on the back of order wins. So that remains the story of the day. But let's refocus and dive straight into corporate conversations on the back of earnings. We've got the management of V2 Retail, Mr. Akash Agarwal, the whole-time director at V2 Retail, joining us on the show. Mr. Agarwal, hi, morning. Good to be speaking with you. And, of course, before we talk about your quarter four earnings, talk to us about your store count guidance, because I remember the last time we interacted in our long-format show, you did give me a guidance about 170 to 180 stores for FY27. And given that you have a history of always beating the guidance that you've given, how does it look for FY27 so far? 170 to 180 stores looking good, or are we looking at another upward revision?
Hi, good morning. Thank you for having me. So for FY26, our target was 100 new stores. We ended up opening 136 on the back of very strong performance, both from old and new stores. And this year, we've taken a target of opening at least 170 stores, and hopefully we can touch the number 200 if the performance continues.
So 200, so you've given me another number to look forward to. So Akash, I'm going to be watching out for that. But let's refocus and talk about the quarter that you've seen. Now, despite strong revenue growth, your sales per square foot, that has declined in quarter four. Is this primarily a result of rapid store additions and store maturity, or are you seeing any moderation in demand, if at all, playing out on the ground?
So our same-store sales growth was, in fact, 8.6% for the whole year. Okay. So if you look at only our old stores in isolation, the per square feet sale of those stores are above 1,100 rupees per square feet. But because we opened 136 stores and they start at about 70% of throughput of old stores, the whole company's PSF comes down a little. But as these stores mature over the period of 3 to 4 years, you will see the sales per square feet at the company level rising.
Okay, and you did speak about your same-store sales growth that has normalized to high single digits. This is below the historic levels that we've seen, more than 20%. What would be a sustainable same-store sales growth number to expect over the next 2 to 3 years as your base also now is scaling rapidly?
So because the base has increased from about 650 rupees to 1120 rupees, we target a 8 to 10% SSSG on that number. On account of a higher base.
Okay, 8 to 10%, that's what you're aiming for. And let's also talk about your working capital. Working capital days have increased sharply from 45 to 81. At what level are you expecting inventory and working capital to stabilize once the current expansion phase moderates?
So two things happened here. One, because of the war situation, we saw there could be disruptions in the supply chain. So we increased our safety stock in our warehouse. So we did receive goods well in advance, just to be sure that we were well stocked for the festive season. And also we had planned to open about 60 stores in the first quarter itself. So all the inventory pertaining to those stores were already, received in the warehouse. And third, we did a lot of prepayments. So if you look at it, our credit days have come down by almost best paymasters to our vendor. So we give them the facility of discounting where they can get any of their due bills, get paid right away.
Okay, and given your guidance, you are targeting about 40 to 50% annual revenue growth over the next few years. What are the key levers that give you the confidence in achieving this, and how do you ensure that this rapid expansion that you're undergoing right now does not come at the cost of store productivity and margins or store economics? Give us some light over there.
So we only ever commit to the next 4 to 5 months of our growth, because from the day you finalize a store till the store opens, it's about a 3 to 5 month journey. So we do a business review every month. We don't want to compromise on any of the profitability metrics, any of the EBITDA metrics, any of the investor return metrics. So if we feel that, the performance is strong and we are meeting our metrics benchmarks, then we continue on this path of aggressive growth. And the things that are driving this growth is, of course, better fashion product, better assortment, faster response to trends, improved inventory management, and a lot of digitalization and technology adoption.
Understood. So would it be fair to try and conclude that this 60% growth that you've seen for quarter 4 and roughly 63 for overall FY26, is it going to be sustainable, or can we expect an uptick over there? Even if not an uptick, can we expect this 60% number to be the base case now for your revenue growth going ahead?
So like you already mentioned, we like to understate and over-deliver. So we are guiding for a 50% growth, and hopefully we can beat it again this year.
Is the number that we're going to be working with. Also talk to us about, now that the summer is at its peak, across the country, with monsoons also now expected to approach soon. How have you seen summer sales shape up? What have the fashion trends been, and how is overall quarter 1 for you shaped up so far?
Quarter 1 was in line with the expectations and the targets that we'd set. There was a slight dip in the middle of May, because of external factors. There were a lot of prices going up, but I think all of that is in short term. Long term, I think the whole year we will be able to do 8 to 10% SSSG and a 50% revenue growth.
Okay, these are numbers I'm going to remember for our next conversation, Akash. And lastly, let's talk about the sector. Value retail has been one of the strongest performing consumption segments over the last couple of years. Do you believe the runway for market share gains remains as large as it was 2 to 3 years ago, while this was still an emerging space?
I think it depends on the execution and strength of each of the retailers. If you are able to increase the gap in the offering between the unorganized value fashion segment versus the organized segment in terms of product offering, in terms of the kind of fabrics, the colors, and international trends, then I think sky is the limit, and we can actually do better than how we've done in the last 3-4 years.
Okay, sounds good. On that note, Akash, thanks so much for your time. Good to be speaking with you as always. Going to be watching out for that store count number as well as your revenue and triple SG growth. Thanks so much for your time today. Okay, viewers, on that note, it's time to slip into a very short break. More corporate conversations lined up on the other side. Stay tuned. Mala. And apart from earnings, the other big talking point in the market has been the waiver by the government of this 11% import duty that we've seen on cotton. How is that going to play out for some of the players within this basket? Let's get into a conversation with the management of Sanatan Textile. We've got Mr. Sameer Dattani, director at Sanatan Textiles, joining us on the show. Mr. Dattani, hi. Thank you for joining us. I understand you're traveling, so thank you so much. Appreciate it. And let's take a look at this 11% import duty that is going to be suspended for the next 5 months. Give us a sense of how this is going to aid the business and how competitive does this now make Indian businesses compared to peers in Bangladesh as well as Vietnam?
Hi, good morning. Thank you for having me. So, of course, this is a brilliant move by the government of India and a great support for the entire textile chain. And this not only reduces the input cost of raw cotton, which is the starting point of the textile chain for cotton yarns and then cotton fabrics, it also makes us more competitive. It will definitely help with boosting demand and somewhere balancing the increased cost that we manufacturers have seen recently because of the West Asia crisis. So at Sanatan Textiles, we manufacture cotton yarns and we manufacture polyester filament yarns. And both have different raw materials. The polyester raw material, which is petrochemicals, PTA and MEG, had an import duty relief from the government last month for a period of 3 months. And now we've seen this in cotton. So this is a great support for both our divisions, the polyester filament yarn division and the cotton yarn division. And this is going to help with better margins and improve demand in the coming months for sure, and also make us more competitive in the export market.
Understood. Mr. Dattani, you did speak about margins. Now, with the government removing this 11% import duty, do you expect any meaningful reduction in fabric sourcing cost? And this margin that you were talking to us about, what could the potential flow through be to the margins if you can quantify the cost saving as well as in terms of bips, how is this going to positively impact your margins?
So I think in the short term, we should definitely see an improvement of 1 to 1.5% in the cotton yarn margins for sure, could go up to 2%. And with the improved demand because of lower yarn cost and lower raw cotton cost, if the improved demand will definitely help strengthen margins for the entire ecosystem, for the entire chain.
Point taken. And
the lower cotton cost will help with the lower cotton cost will help with better yarn pricing and thus help with better fabric pricing.
Okay, understood, Mr. Dattani. Let's shift focus from this topic and talk about the company's Q4 performance. You've reported revenue of about 3,800 crore rupees, which was below the guided range of 46 to 4,800 crores. Can you help us understand the main reasons behind this? What was the pressure on the top line? And now this guidance of 56 to 5,700 crore rupees, what are going to be the key levers to achieve that?
So our initial guidance was on the basis of our expansion in the polyester filament yarn business, where we've just set up a new factory in Punjab. It's a greenfield project where we invested close to 2,200 crores, which eventually will more than double our top line in the coming years. But we saw a delay of 1 quarter in the startup of that facility, which we had indicated in our December quarter numbers and guideline. That we had a delay. It's a greenfield project, so we've been working on it for more than 2.5, 3 years now. But by the end of March, the entire project is fully commissioned and up and running. And because of that, we are confident on our indication of the top line for FY27. We're also expanding our cotton yarn production capacity. We're adding 75,000 spindles of new cotton yarn spinning at a greenfield site in MP, Madhya Pradesh, at the PM Mitra Textile Park. And the work on that will start later this year, and that is expected to commission in FY28 in a phased manner.
Okay, and while you're talking about your expansion plans, my next question to you was on your Capex. If you can help us...
So, looking at this and a further increase in FY28 and FY29.
Sure. Okay. Mr. Dattani, can you quantify your Capex for us in FY27, please?
So in FY27, we'll be having a little bit of Capex for the phase 2 of Punjab. and we will start MP. And further deployment of that so the cotton yarn facility in MP is a 400 crore rupee Capex, but that will happen over a period of 2 years. The deployment of the capital will happen over a period of 2 years. As far as the Punjab facility is concerned, the phase 1 is fully commissioned. By the last week of March this year, we commissioned the entire phase 1 and we deployed the entire 2200 crore rupees of Capex that was planned for that facility. And that facility in the phase 1 has an expected additional revenue of 3,000 crores with the design and the plan to do a phase 2, which will give us an additional revenue of 1,000 crores and will require a Capex of about 150 to 200 crores for phase 2, which will also happen during FY28. We will start that journey by the end of FY27 and complete it in FY28.
Satani, how will this Capex be funded, this 150 crore amount that you've just told us about? Is it going to be via debt? Is it going to be funded internally?
No, we have already drawn down our peak debt, which is close to about 1,300 crores currently, our net peak debt. And both these upcoming growth plans in the polyester filament yarn business and the cotton yarn business will be from internal accruals. At the moment, we are not looking at adding any new debt. And we are seeing healthy cash flows because our Silvassa facility, which is currently fully operational and has been consistently giving us a revenue of close to 3,000 crores, continues to run at optimum levels.
Okay, that sounds good. Mr. Satani, talk to us about what part of your revenue pie comes from exports and what's the outlook over there. Which countries are you targeting at right now for exports, given that there's so much disturbance in West Asia?
So because of the disturbance in West Asia and prior to that, the Russia-Ukraine war, we brought down our export exposure, which was as high as close to 20% revenue was coming from exports 2 years ago. We've slowly brought it down to close to 5 to 7% currently, very strategically, because the domestic market was giving us a better net back, and it was a far more stable business model that we were seeing. Also, the growth in the domestic textile consumption is very, very robust at a larger level, and it definitely makes sense to cash in on that opportunity in the domestic market. So currently, I think between 5 to 10% would be our expected revenues from export.
Okay, understood. On that note, Mr. Tatani, thank you so much for taking the time out to speak with us. And viewers, that was the management of Sanatan Textiles, quantifying the impact that this 11% import duty waiver from the government for cotton imports is going to have on their business. They say that this is going to make their business more competitive versus peers in Vietnam and Bangladesh, may contribute to the EBITDA margin to an extent of 2%. So sounding very optimistic, they've said that this revenue guidance of 57 to 5,800 crore rupees is also going to be achievable in FY27, and double-digit margins is what they're aiming for. Already at 9% in Q4, and saying that this 2% gain expected from this import duty waiver could hit their margins very soon. This double-digit EBITDA margin guidance also seems very achievable in FY27. So that's a roundup on Sanatan Textiles. Stock is slightly under pressure right now, lower by about 0.8%, but as has been the breadth of the market. Speaking of, you have the market that continues to trade under pressure of about 0.3%, and now we're once again hanging on to that 23,300 mark. Sensex is lower by 0.3%. It's Nifty IT that continues to dominate the breadth of the market sectorally. You only have the IT index that's lower, that's higher by about 4.25%. Very healthy jump coming in on the IT space. It's names like TCS that's up 6%, Infosys, Coforge, HCL Tech, Emphasis, all doing very well on the back of that CLSA report that says that SaaS apocalypse is not playing out in a big negative way for IT companies. And of course, Jensen Huang's comments on software will continue to be a key part of Indian IT. Overall, you have IT doing good. You have Nifty Metal that's higher by about 0.2, but these are the only two sectors in the green, because you do have some cuts, massive ones on pharma, 1.5% lower, followed by Nifty Finance, Energy, Bank, PSU Banks, Autos, Defense, Media, FMCG and Realty. That's the list of the most to least losing sectors in trade. To sum it up, yes, 23,300 seems like a testing mark right now. We've slipped below that. Let's see if we're able to climb back. It's the expiry day pressure that's clearly playing out on the markets. But with that, we're completely timed out on this edition of Midcap Masala. Thanks so much for tuning in. Stay on to ET Now. Buy now, sell now is up next.